I'm delighted to welcome Barry Dawes again. He gave us a fascinating presentation yesterday, and he is going to be talking to us now about the Australian gold sector. Ladies and gentlemen, Barry Dawes.
Thanks so much. I want to follow on from some of the things I said yesterday. Now, not everyone was here yesterday. Can people tell me who wasn't here yesterday?
I'm not all here. We can see that.
Okay, so there's just some of the things I'll run through which were in yesterday's presentation. So if you've seen it before, hopefully it will refresh your memory. If those people haven't seen it before, I think you'll find it interesting. Gold is really important in Australia, and from my point of view, I really believe that the gold price drives the resource sector. It's not our biggest export because coal is our number one export by a long way, and iron ore comes second, and then it's between aluminium and gold, but I just see gold becoming more and more important as we go through. Gold really drives the speculative side of the market, drives the second line stocks, and it also has the effect of attracting a lot of foreign money. And by that I mean from the UK, from China, Hong Kong, China, Japan, from the United States, and also from Germany. And so far I have seen very little of that money flowing into the Australian market. A number of times I've made the point that here we've finished 10 years of bull market in gold, and it's almost so what? So many people are not on board with bull market in gold and other commodities. So I think we've got a long way to go as the fundamentals from the international position start to really focus on where we're going, and then as people recognise that the gold price is improving, and as we see the operational developments are taking place within the sector itself. Again, I put a disclaimer. I basically earn money through commissions on share transactions, and also from capital raising. So companies that I mention here, I may have received a benefit from it. Now, into the 21st century, I really do believe that the Australian gold sector is going through a renaissance. And clearly we've got a rising gold price. We actually had $1,500 an ounce back in about March of this year, when the $8 was relatively low and the gold price went through $1,000. More recently it's around $11.40, and it's been remarkably steady over the last just about 2 months. It's only moved within $30 or $40 of that, so it's been quite solid. And we're starting to see this rising gold price stimulating production, stimulating activity and exploration, and we're seeing a re-emergence of Australian gold producers. And I'll come back to that and you'll see the significance of it. And I believe that the gold sector stocks now are in a major long-term uptrend, and we're only in the very early days. You might have seen something, I think it might have been the Economist, but they said that Sydney rated number 2 in the world for capital raisings, and this is an extraordinary thing because usually you think of London and New York, but what actually happened was that our banks raised about $12 or $13 billion, and then there was very substantial capital raisings amongst the gold stocks, and it was interesting. The gold price was moving up, and as I said, it got up to $1,500. So the Newcrests and the Lahirs went and raised big chunks of money, and then over succeeding months, the progressively smaller companies received some funding, and then over the last 2 or 3 months, we'll be looking at the smaller ones. Now that reflects the fact that there was a drought in terms of equity capital available for the gold sector, really from about very late 2007. So, if you like, the sector's been recapitalised, and that money will go into new projects and new exploration. And exploration activity is at a high level. It was down a bit in the year to June of 2009. As most of you are probably aware, Australia has a June financial year, so things like AB will report data in the June year. But that exploration was down in the June year, but I can see it picking up in the June year to 2010. It's in my view that the sector is still very much under-owned. Australian institutions are very, very underweight resource stocks. They tend to stick to the highly liquid large cap stocks like Lihir or Newcrest or BHP, Woodside, and very little underneath that. So I believe it's still under-owned, although a lot of these capital raisings that we were talking about recently did go to institutions who really weren't participating in the market previously. But I think we're still at the early stages of the bull market. Now, the Australian market is really reacting to all the international influences. And one very important thing is that world production is declining now. As I'm sure you're all aware, that this will be the 9th consecutive year of a decline in world gold production. And the main reason for that is the decline in gold production in South Africa. And in the same time, we've seen declines in Australia, the United States, a rise in China. China's now the world's largest producer, and places like Peru are in the top 4 or 5. What I believe that the gold sector is anticipating is at the end of fiat money. Obviously that's going to be discussed by Professor Fekete in far better detail than I'd ever imagined. But it's one thing which people are recognising around the world, and I think that's one of the reasons why the gold price is so strong. The other thing which is really important is Chindia. Now, I mentioned yesterday, that's China and India together. Around about 1000 AD, you could say that China and India made up 75-80% of world GDP. They did a Rip Van Winkle. They went for a sleep for the 20th century, and they've woken up, and they want to reassert their rightful position of 75 to 80% of world GDP, reflecting population. There's some really interesting things for us to think about when we think about what economies are at different currency levels. I'll leave things like that. If the currency falls 30 or 40%, does GDP fall? And it won't fall by 30%, but does it fall? Does the asset value of the underlying GDP fall when the asset value of the currency falls? These are interesting things for us to think about. But it just will accelerate the growth of India and China. The other thing you should be watching is MENA. You may not have heard of MENA, but MENA is Middle East and North Africa. The Middle East is doing extremely well through all the oil revenues through the Gulf states. Saudi Arabia is starting to industrialise. It's starting to go into the mining business, although Rio Tinto decided to wouldn't join them. Another great act of bastardry by Rio. But you also need to understand the amount of investment that's going into the gold sector in North Africa, in places like Mali and Burkina Faso and Guyana, all those Guinea, all those areas in the hump of Africa. They're getting real projects being built, and they're getting stable economies and actually growing. And the other thing is Latin America. Now, I mentioned yesterday, Latin America's got 600 million people. And Chile and Peru, Colombia, Panama are all running budget surpluses. They've got good exposure to commodities. They've repaid all their debt. Their public sector is being restrained. Argentina repaid all its debt and then it started to go a bit wobbly. And Brazil itself, which is the largest with about 300 million people, it's also done quite well, although I think it's got about $60 billion in US treasuries. It didn't repay all its debt, and it's got some US treasuries. So they're very important in terms of living standards rising. Now, in my view, bond markets around the world are breaking down, and I'll come to that. I mentioned this yesterday. Very important for you to understand, well, what I think is happening anyway. I see that the currencies are in turmoil, and it's not just the US dollar, it's going to be the yen, it's going to be the euro, it's going to be the pound. And I'll call this a major risk of of inflation. Here we talk about monetary inflation, and probably at the same time we're looking at some effects to people's overall living standards. But however we look at it, gold is in a period of major revaluation at an international level. Looking at gold production, I mentioned before that this year will be the 9th year of decline in gold production. So we're producing around about 2,400 tonnes a year, and I can see that declining primarily because South Africa will be continuing to decline. The reason South Africa is declining is that it's too difficult to invest in South Africa to do things like put in new shaft. If you were to put in a new vertical shaft which is going to go down 3 or 4 kilometres, it's going to cost you about $2 billion US. And no one is going to lend a South African company $2 billion to put that shaft in it, and it might take them 5 or 6 or 8 years. It's just not going to happen. So I expect that gold production in South Africa will continue to decline. Peru will increase, China will increase, and Australia will recover. I mentioned that I believe that bond markets are breaking down around the world. Now, this is one of the most significant charts that I show, and it's one that you should all become familiar with, if not already. This is the long Treasury bond, going back to the last cyclical low that I could see, which is 1942. And from 1942 up to 1981, we had 39 years of rising interest rates. We had Lyndon Johnson's Great Society matched with the Vietnam War, and that basically led to a period of inflation. The gold price, as you will recall, peaked out on the 21st of January 1980, and interest rates at the long end peaked out in the first quarter of 1981. And then after that we had 28 years of falling bond yields or declining interest rates. Now, the first 15 or 16 years of that, in my view, was disinflation, where we actually had the rate of inflation falling. Inflation was still there, but falling. And then we had this period that I would call deflation, which really affected the commodity sector. Now, Dave Harris yesterday kindly suggested it was probably Clinton's people trying to manipulate the bond market and manipulate commodity prices, because it's interesting that we had a very important low in bond yields here in October 1998, which was the same month that the oil price bottomed, the nickel price, the platinum price, and the aluminium price. The gold price bottomed a few months later in March of 99, but that represented a period of deflation. During this period, we saw the oil price smashed under $10, the $8 was smashed, the Canadian dollar was smashed. So many commodities were affected. Now, since then, in my view, we've seen manipulation by the US Federal Reserve in bringing interest rates down, and we saw that final spike low in yield late last year when we saw 2.5% on long-term treasuries. That, to me, marked the end of this bull market in bonds. The other really important thing that I've deduced from this is that since about 1990, and this is after the 87 crash, the 87 crash in Australia just destroyed the mining industry. It was impossible, it was extremely difficult to near impossible to raise money between 1988 and 2001. So we had a depression of about 15 years. But what became very, very important is that anyone who had anything to do with the resource sector, if they were in a big merchant bank, investment bank, if they were in funds management or in the broking, basically got demoted because there was no money to be made for the firm. If you're chief investment officer, hey, you didn't need to have any resource stocks. They were dead forever. You just went and bought banks and infrastructure stocks and retailers and anything else but resources. So the whole resource sector knowledge base has been removed from many of those institutions, and it's only now just coming back. So but basically what it meant is that anyone who was 30 years old in 1990 and today is 50, he's had his entire career investing in a period of declining interest rates. Now that's the CEOs, that's the CFOs and CIOs, Chief Investment Officers. So the whole world is geared to declining interest rates, and that's why I think they're going to find quite a shock as we go forward. But this is going to have a big bearing, and the prices of bonds, big bearing on gold in my view. I also showed this.
Sorry, very cool, if I may. So if the interest rate's going to go up, that means the bond price is going to go down.
That's right, yeah. And also because the coupon is relatively low now, a small rise in the coupon has a big bearing on the capital value of the bond. Now, this was another thing which is fundamental to the outlook, I think, for commodities and equities generally, but particularly commodities, resource sector equities. And that's the amount of cash on the sidelines. Now, this is from the Bank Credit Analyst. Now, this is from March. But what it said was that in March, the Wiltshire 5000 index, which is a very broad index in the US, contains all the S&P 500 and the next 6,000 stocks, about 6,500 stocks there, has a capitalisation of about $13 trillion, so a nice broad index. But the cash on the sidelines in banks and cash management trusts, 95% of the capitalisation of the stock market was in cash, earning 0.2%. Now those numbers have come down a bit, but the interest rates haven't gone up. So you've got to follow the money. You've got to follow the money. It's not about GDP. It's not about economic recovery. It's flow of funds. And we've got to find where these funds are going to go. And they're certainly not going to go into bonds. If they go into bonds, they're not going to be there for very long. And not only will we have money coming out of cash, we'll have money coming out of bonds. So that's going to be a big driver, I think, for commodities generally as we go through the next few years. In my view, we've got the US dollar breaking down and the pound breaking down. Now, it's my view that the A dollar will go through parity and much higher than that, but we will also go to parity and higher than that against the pound. If you look at what's going on there, they've had 6 quarters of negative growth. They have very little manufacturing industry. Most of their economy was associated with finance, construction and property, and all those three related in London. They're now a net importer of oil and gas, so they're not in a very strong position, and Mr. Brown has sold all their gold, and they've been doing quantitative easing there, so the outlook for the UK I think is quite good. And I would say that given the disparity in the performance of economies within Europe, we'll probably find that the euro will find it difficult to run for more than a few more years. But I've been saying that perhaps a bit too long. But I think it's still going to have some real problem. I think we will see the UN rising as it becomes more and more important. So I'd say there that the $8 will rally above parity against the US dollar, and we've recently made 25-year highs against the pound, but we will just continue to go there. Now it's really interesting talking to people in the UK and the US to a lesser degree. They're saying, oh, the Australian dollar's too high, I won't come and invest. I'll wait for it to come down. But they're still not getting the story yet that they will need to hedge against currency weakness, and the best place is really gold stocks measured in $8. Gold and silver would still be the best currencies, but it's going to be the gold producers and the general commodity currencies that are going to be the best performers, I think, over the next 10 years. You're all familiar with this US dollar index. As you know, we're around about 77, 78 on this index. I think we're going to come down here somewhere. I noticed someone suggest that we'll get a rally up about here, which I find a bit hard to believe, but anything can happen with these markets with manipulation. But I think overall this currency will come down. This is not a very good index because it's about 57% against the euro. It's got the Swedish krona there, it's got the Canadian dollar, the yen, the pound. So I don't think it's a very, very good index, but nevertheless it's the one that everyone follows, and I think that it's going to basically break this sort of downtrend line over the next 12 months. So there could be a much weaker dollar. It will come down, I guess, steadily like that rather than just a very sharp crash, I think. In the short term, you're all familiar with these things, I assume, but it's travelling below its 50-day and 200-week moving average. I guess it can rally up here a bit, but I think it's still going to go down. Looking at the A dollar, it was funny. The last time I was in Canberra, I lived in Canberra, worked in Canberra when the currency was 149 against the US dollar in the very early 70s, and it's been a pretty sad story, one-way street down to our low of just at 48.5 there in 2001. But we've had a good recovery. Sold off very, very heavily in the market turmoil last year, but we've recovered quite well. Got up to, I think we went to 93 intraday. We pulled back a bit, but I think we're going to continue on and come up to about $1.12 in the not too distant future, and longer term go and challenge these highs. This is very interesting against the pound. This is from 1983. I found it very difficult to find longer term data, but we made 25-year highs at around 57 a week or so ago, and I just think this is going to continue to be quite strong.
Can you talk about the significance of a strong Australian dollar to the Australian economy? Because our exports are going to be...
That's true, but if we think that Australia is a resource currency, essentially, because about probably 55% of our exports are resource sector exports, then plug a bit of agricultural stuff on there, and other exports aren't that big. Sure, agricultural gets hurt in the short term, and manufacturing gets hurt, but prices for commodities rise much higher, much faster, in greater percentages than does the rise in currency. The rise in currency is the best thing that we can have, because it means that we're forced to be more productive, we're forced to change our work practices, we're forced to make changes everywhere. And it's in everyone's best interest to have a strong currency, in my view. I much prefer to have a strong currency and be able to buy things more cheaply than have a low currency and not be able to buy anything and not be able to go anywhere. So strong currencies is the best thing.
So don't that make our resources too expensive for China? Wouldn't they prefer them to buy from Brazil or somewhere else?
Well, Brazil's probably an even stronger currency than the $8 at the moment, believe it or not. But if China decides it doesn't want to price in US dollars anymore, because if the yuan rises, obviously US dollar prices are falling for them. But at the end of the day, it doesn't really matter. In my view, it doesn't matter. People will pay whatever the market is. It has some impact at the margin, but they will pay whatever is the rate. That's been my experience. Now, this is very interesting. This is the A dollar versus the Philadelphia Gold Index, going back over the last 15 years. And you can't get it much better than that. I used to follow the A dollar against the old CRB index, deflated by the US GDP deflator, and it was a pretty good match up until I think it was up until about 1996 when they sort of smashed all the currencies and just didn't make sense anymore. But against the Philadelphia Gold Index. So it's quite a remarkable match.
Do you know what the correlation is?
So I haven't done it, but I'd say in our street about 97%.
Really?
But just eyeballing it. It's just, it's just one of those things. It's magic. It's just, but it works. In the olden days, sorry, about 25 years ago, it used to be that people would just follow the copper price and push the $8 up. Oh, what have I done? Push the $8 up when the copper price moved. But the funny thing was that Australia really only had one copper mine in those days, now owns a mine, so perception's everything. It was amazing they used to just manage the $8 experience by the copper, the $8 exposure by the price of the copper, price of copper. So the gold outlook, we've seen record high gold prices in all currencies this year. Now we don't have record prices today in all currencies, but the $8 saw its highs earlier in the year. But it's quite remarkable how things are volatile. But if you did gold price in a basket of currencies, it's recently just started to kick up, and I think that's going to move to new highs again in 2010. But importantly, gold prices in real terms, in real US dollars, are still very, very modest. I mean, we're only about 50% of the level we were in 1980 when the gold price was $875. So gold price at the moment is not overextended, particularly given what's going on around the world, particularly in terms of worldwide monetary stimulus and quantitative easing, which is taking place in particularly the US and in the UK. So I think we've got quite significant upside in the precious metals, and gold equities are ready to surge after a 28-year consolidation. I came across this chart just a week or so, and I thought, holy cow, this is just amazing. You might remember my interest rate chart. We've had 28 years of decline in interest rates and rising bond prices, and we've seen a turn. And the gold equities in the US, according to the S&P Gold Index, have been consolidating for 28 years. And I think this is one of the reasons why I'm so frustrated, because I hadn't appreciated the longer term issues that are at play in the XAU and the Q. We'll come to that. Now, there's a gold price in US dollars. You're all familiar with that. We've taken out the 1980 high. The low was in March of 99, so we've had over 10 years of bull market. I'm a stockbroker. I'm in the business of basically raising money for resource companies, but primarily gold companies, and people still aren't knocking on the door waiting for our latest IPO or our capital raising that we're doing. They're not lining up outside. They're not ringing us. There are a few. We go to a number of conferences, and you pick up half a dozen sort of new clients who are enthusiastic, but for the most part, people aren't interested yet. That's why I think we're still very early in the stage. Now, if we look at the real gold price, if we took today's price and put it back compared to where we were in 1980, we should be $2,000 today. So, what it's really saying is that we're only about 45% of.
Larry, you use the official CPI. You use the unofficial CPI. That hasn't been corrected. It's more like 6,000.
I don't want to do that sort of stuff.
You could do it here. You don't come here any hours without with you.
No, you're perfectly right. But I mean, I have no problem at all seeing gold price at $5,000 or $6,000 in the next couple of years. I mean the next couple of years. I am of the persuasion that we will see quite a strong rise in gold price, mainly because of the flow of capital into the gold sector and the gold stocks, and particularly when you see just a couple of other things. Now, this is the XAU, the Philadelphia Gold Index, which unfortunately is the only one I can get on IRIS. can get the Huey on a different system, but I can't manipulate the data. But the thing that I found so interesting about this is that we had our low, and this bull market has certainly climbed a wall of worry. You've heard the term bull market, climb a wall of worry. We had 2 steps forward, 1 step back. 3 steps forward, 2 steps back, and another couple sideways. 3 steps forward, 1 back, 3 sideways, 2 steps forward, 3 sideways. I really thought this one was the one where we were going to really rally last July, August, and of course it didn't quite work that way. And it just got smashed down. And this is not natural selling. This is aggressive shorting, and this is stupidity. I couldn't believe what happened last year because it didn't make sense. Not in the resource sector market compared to the fundamentals that I understood in terms of supply and demand, in terms of price levels and what was really happening. Last year was an aberration and stupidity, particularly when you saw how much these things have rallied back. And remember when we compared it to the $8? The $8 had a sell-off and has come back. Now, one other thing I mentioned yesterday, the resource sector made its lows in November, December of last year. So we saw the commodities make their low, the resource stocks made their low, the Chinese, the Shanghai index made its low on the 31st of October, Hong Kong made its low. The Dow, S&P, the FT, the DAX, the CAC, all ordinaries, they all made their low in March of 2009, and the resource stocks did not confirm that low, and that shows you the relative performance. People thinking that the end of the world's coming, you've got to sell the cyclicals. In reality, they had relative strength, and they're displaying that relative strength. That relative strength will continue. Now, if we take that Philadelphia Gold Index and divide it by the gold price, we find something else which is very interesting. The average of this eyeballing is about 0.3 from, I'm sorry you can't see that, that's from 1988, or sorry, 87. So if we go to that, we're talking over 20 years, the average is about 0.2, and it got really sold down, the stocks got sold down relative to gold. So the stocks last year were ultra cheap, but they're still at the moment, and that level is 0.16, so there's still about a 25% discount to the gold price. So gold stocks in the United States are still cheap relative to the gold price. Now this is from Eric de Groot. Those people who look at Jim Sinclair's website will recognise it. Eric's a real pessimist about the economy and whatever. He's a guy who puts all those shadow stats down when he has his own. It's all pretty miserable. But instead of us looking at this thing, which doesn't show you very much, and most people won't give you any more than about 20 years of the Philadelphia Gold Index. Well, have a look at this one. This is the S&P Gold, which has been put together by Eric de Groot. It used to be the S&P Precious Metal Index. Now, I almost fell off the chair when I saw this because it explains a lot. There's the high in 1980, and the gold sector is still at the same level as 1980. Now, intuitively, would people have thought that? Because I thought that, you know, an index is reflecting human endeavour. I mean, share prices reflect human endeavour. You want to go out, you're going to build a mine, discover a deposit, you're going to construct a mine, you're going to produce gold, you're going to do something, you're going to add value to shareholders. You're not going to sit back and just do whatever the commodity price does, because you know, that's what's happened in any equity. So it really surprised me to find that we were at the same price right now that we were back in 1980. So this 28 years of consolidation, with this long-term rising uptrend coming from 1921, so nearly 100 years of history, we don't have very long at all before we get this moving up to the top part of this trend channel. And if we go up the top part of this trend channel about here, that's about 1,000 on this index, so it's got to move up by 200%. So that's the index moving up 200%. That means the big stocks have got to move up probably 180%, 150%, and the little stocks have got to go up a multitude. So that, I think, is about to be, that's about what is about to unfold. It's very interesting if we look I mean, you're all familiar with the idea of home state going up 100 times or whatever from 1927 through to 1932. Remember in those days that we had a gold price which was revalued, but it was fixed, and the price of just about everything else fell. The price of labour fell, the price of gasoline and diesel fell, so they got a huge increase in margins. So if you were a gold producer, it was fantastic, and we saw the increase in gold production. So, but thereafter we had 27 years of sideways movement. Now the 27 years doesn't mean anything relative to the 28 years, but what it shows is that matches my bond market, that matches this uptrend, and I think we're going to see a big move. And it also, if you like, helps to understand the angst that seems to go right through the gold community. It feels that the world is against them because the stocks go up and they get smashed down. But they don't. I mean, if you watch Kitco 24-hour price, you can see that it gets smashed on the opening and then it might rally up and it's smashed on the close. And clearly, it's market manipulation. It's not natural selling. So whatever's happening in the stocks is basically from the same thing. So I think that it's reflecting this 28 years of sideways movement where there's must be some crazy investors there. You wonder what their investment philosophy is. But I think we're coming out of that. And this one again, with credit to Eric de Groot, he's saying that this is the blue is the gold price, and the gold price is leading the gold equities. So it won't be long, guys. It won't be long. It's worth the wait. Hang in there. And it's interesting. I was just looking at something overnight, which is basically saying that as of Friday, the gold sector is the most oversold it's been since the real sell-offs that we got last year. So I'll get onto that in a minute. But I think what we're doing, we're at that end of the sell-off, and it could be quite exciting going forward. So coming to Australia, it's been significant that the gold industry in Australia has been significantly rationalised. I guess that's one of the reasons why there's not a lot of interest, because there's not many stocks to buy. They've all been taken over by Barrick, Anglo, Goldfields or Newmont. And I see that we're coming through that now, and a new breed of producers are coming through. We'll see a production upturn into next year, and I expect that exploration funding will be expanded. And very importantly, exploration drilling is going to go under 100 metres depth. Now, people need to understand, particularly if you're from overseas, as you know, Australia is an old continent. It's pretty stable. It's got a couple of important cratonic areas. We've got terrains that are essentially hundreds of millions of years old. So there's been a lot of erosion, and we also have quite a lot of oxidation of the rock, often down to 200 or 300 metres. So in Western Australia, particularly where you've got these old terrains, the gold production that's taken place there has been in oxidised materials, and consequently the mining approach is to sort of look for a relatively large open cut, and it's just a matter of doing a whole bunch of RC or RAB exploration holes, go and get the assays, plug them into a computer, the engineer comes along, or geologist comes along, yep, there's a resource there, that's the average grade, engineer comes along, here's the mine pit, get an off-the-shelf CIP plant, put it there, at a gold vein to get the capital, and zip, and you're off. That's really what happened, and that was responsible for that tremendous increase in gold production in Australia that I'll show you in a moment. But what's happened over the last 2 or 3 years, people like Goldfields, which took over the Western Mining St Ives operations, and Avoca, and Integra in particular, have started to drill down. And you find that about 90% of all the drilling to date has been less than 100 metres. So it's been in the oxidised zone. We're starting to go below that, and some of the grades they're finding in the discoveries are quite exciting. So we're going to find a lot more. There's a lot more exploration going. We've made a number of significant discoveries, and we're going to find more coming through. But however you look at them, we've still got asset values that are very severely discounted. We've still got gold companies on PEs of 3 and 4, believe it or not. So clearly we're not in the late stages of a bull market. So there are excellent long-term opportunities to come into the sector. I hope you can read this, but basically what it says is these are the top 10 gold mines in Australia. This is the operation, and this is the operation with Super Pit in Kalgoorlie, Telfer up in the Pilbara, Sunrise Dam in the Yilgarn, St Ives near Kalgoorlie, Acadia in New South Wales, Tanami in Northern Territory, Ridgeway in New South Wales, Kanowna near Kalgoorlie, Cowell in New South Wales, and Plutonic. Is that one of your mines?
Yeah, I got it.
Yeah. And Kalgoorlie, and just note, Newmont and Barrick own the Super Pit. That's our largest mine, not owned by an Australian company. Newcrest, that's an Australian one. Anglo, Ashanti, that's obviously not from Australia. Goldfields, Newcrest, then Newmont. Newcrest, Barrick. And the production is 600,000 ounces here at 579, 433, 418, 402, 287, 278, 267, down to 127,000 ounces. So our top 10 gold mines, of those, you can actually see 7 of them are owned by foreign companies. So there isn't much experience or exposure in larger scale gold mines in the Australian market outside of Newcrest. That's very, very important to note. But that's going to change. Now, Australia's production history. I was fascinated with the history of Australian gold production, and I went back and plotted it from essentially 1857. Now, 1850. Now, Philip Bruce was telling us about this fellow Hargraves, who supposedly found the first gold in New South Wales, and he was actually rogue. This guy named William Tipple Smith, who found that. I think he's a relative of mine, but that's by the by. But he found it, and Hargraves took the credit. But gold production went sort of fairly steadily, and it peaked in 1900 at about 100 tonnes, and then sort of declined, and by 1920 it fell about 75%, and it stayed around 30 tonnes right from around about 1925 to 1960. There might have been little blips for the Second World War, and I can't remember if it was up or down, but there was a blip. And it was interesting, in 1930 when we had the rise of the gold price, there was a little blip of increase in production, but the main reason there was no increase in production, there was no capital. There was no capital to invest. Capital is really important. The resource sector, particularly the gold industry, is very, very capital intensive from the exploration side to the development side, and quite often that capital was not available. It's also important for everyone to understand, just to put a little twist in things, up until about 1990, gold was tax-free, or sorry, profits from gold mining were tax-free. Now this is a really interesting thing. I was against it. I'm not in favour of taxing, but what it meant was that every dollar you spent was capital. Now if you start thinking about having a balance sheet which has got gold in it instead of cash, think about it if you have no tax, which means that every dollar you spend is capital. It goes in a capital item, it's not an operating cost. It's the equivalent of capital. It's an interesting one to think of. So getting a new pencil is a capital expenditure. So anyway, that was taken away, but that did have a big impact. But you can see that gold price peaked in 1980, but it took 3 or 4 years for it to have any impact. And then, but by 1990 we were up to 250 tonnes, and then it peaked out at just over 300 tonnes in 1997. And so we had essentially 12 years of decline. This year should be down a little on last year, but next year should start to rise as Philip's projects come through and push the project up. But we're on the way up again, and that's the revitalisation of within the industry. Now it's also interesting to see what's happening by state. Now Western Australia by far and away is the most important gold producer, and it's interesting that I think it was only about 1995 or 1996 that Western Australia finally surpassed Victoria as the source of gold. Now Victoria's produced next to nothing since about 1920. It's a very sad story, but Western Australia took essentially 100 years to catch up to Victoria. But what is interesting is to see where New South Wales is coming through, with Acadia Ridgeway from Newcrest and Lake Carroll, and soon we'll probably get up here with Helene, won't we? So that's going to increase. So state by state things are moving along. Now this is very interesting to show what has sort of happened. Australian gold production declining since 97, as you can see, but interestingly our costs were relatively steady, and then we had a huge increase over 2007, 2008. That reflected higher prices for distillate and higher costs for everything. There was a huge boom in the resource sector, as you know. Prices for geologists, for field assistants, for drilling just went ballistic. And so the cash costs for 2009, we forecast for our universe about 690. Now that will come down into 2010, but it's quite sobering to think that we need $600 to make money. That's cash costs without taking capital costs into account. So Australia needs a high gold price, and almost everywhere except probably China needs a higher gold price to maintain production. And the other interesting thing, Professor, this might sort of help your comment. When the gold price goes down, the grade tends to go up, and as the gold price comes up, the grade can come down because you can treat more ore. There is a reservoir, if you like, of gold in a deposit, but it's really defined what we call the cut-off grade. The cut-off grade is the lowest grade that you would put through the mill. Now obviously if the gold price goes up, you can reduce your cut-off grade, which often will significantly increase the amount of gold that's in your reservoir or in your reserve. It's a matter of mine planning, but generally as the gold price goes up, we will get an increase in reserves, and the companies will tend to mine as much of that reserve as they can profitably. Now in terms of exploration, we've got substantial increases in dollars over the past few years with some important new discoveries. I'll point those out. I'm sorry, we've seen a lot of tenement consolidation as well, and that's very, very important because the companies are becoming stronger, merging companies together, having bigger tenement bases, and successful deeper drilling in gold and copper. Now, these are the gold mineralisation areas that you need to be thinking about. The Yilgarn in Western Australia has produced an extraordinary amount of gold. We've had about 60 million ounces produced from the Kalgoorlie pit, but by the time you take everything together, I think we've probably had about 250 million ounces taken out of this Yilgarn area, and they're finding, they're making discoveries to the east of this, which is relatively unexplored. They're finding new deposits up to the north, and also some other things which aren't really in the Yilgarn, but there in Western Australia. Tanami is a new province which is growing, and we're going to find more gold there, a lot more gold there. And Tennant Creek. Now, Tennant Creek is a gold field that's renowned for its high grades, but next to nothing has happened since about 1981. So that area is seeing a renaissance. The Drummond Basin, some epithermal things, and just to the north of that you've got Charters Towers and all those other areas there. Charters Towers is a very interesting deposit. 6.6 million ounces were produced at an average grade of 34 grams, which is sort of, it's a Don Bradman of gold deposits in Australia. Unfortunately, the things are fairly narrow veins, and they are difficult to mine, but the guys are getting on top of it, I understand. But the other area which is of particular interest is the Lachlan, and again this is where we've got Acadia and Ridgeway, Lake Cowell, and Philip Bruce's Hill End Gold. We're going to find a lot more discoveries here. Alkane's Timingly discovery, and McPhillamys is very, very exciting, and this area around here is Bendigo. So those areas are going to get a lot of attention, and I think we're going to get some new discoveries as the exploration program takes into account new technologies and a lot better understanding of the geology. A lot of these basins in here are still pretty well unknown. They're not very well defined at all, and there's a lot more work to be done. So these are the areas that I mentioned. On Cloncurry in Queensland, near the Drummond Basin, is pretty important, west of the Drummond Basin. Now, exploration expenditures in Australia have been around $400 million. They jumped 50% in 2008. They were down a bit in 2009, and I expect these things to start rising and be quite strong going forward. So the conclusions: gold price is suggesting inflation, monetary inflation, currency pressure, whatever you want to call it. It's coming. And the international interest in Australia is only modest to date, so I do expect to see a lot more interest, particularly out of the UK, because there hasn't been much interest to date, and also from the US if the $8 continues to be strong. Exploration success will drive a lot of these small companies, and gold stocks are in the early stages of a multi-year surge, particularly if that Eric the Group thing is any indication. Now, I talked about this yesterday. This is a bit controversial, but this is very exciting. Now, I know that the Robert Trechter of the Elliott Wave thinks we're here. We're going down to oblivion down there, probably down here. But it's interesting. If we look at this in terms of not so much 1, 2, 3, 4 or Fibonacci numbers or whatever stuff like that, think of it more in terms of moods in the market. And I can assure you that we haven't seen any euphoria yet. Now, last year obviously finished something. It was a down move which finished an up move, whatever it was. But euphoria is usually marked by very strong market breadth. That is, the small stocks are doing very well, the big stocks are doing well. Lots of players are in there. There'll be new funds being set up for gold or commodities or whatever. Well, that didn't happen. We didn't have euphoria last year. And it's interesting, if you go back to the market mood over that period, November, December, January, did anyone see it as an opportunity? No, not the man that, not most people. You read the finance pages, go back and read the finance pages of that period. It was, hey, get me out, get me cash. The world's ending, I want cash. And it was not seen as an opportunity. For the same reason, I mentioned yesterday, we did 13 IPOs in 2007, more than any other broker. I mean, just a little broking firm in Sydney, we did 13 IPOs. Well, as I mentioned before, only one of those did we have other brokers saying, hey, we want stock in that. And the others we actually had to sell to our client base or whomever. And most of them did quite well. But there was no queue of people to get prospectuses. The phone wasn't running hot. People wanted to get on board. So, and also the institutions would only have 3 stocks, as I would continually find, that had BHP or Rio. That would give them their diversified resources. They had Woodside, because that would give them oil and gas, and then they would have Newcrest, or because that was gold. Liquid stocks, they're the only ones that were there, so we had no optimism. So we come back to this thing, well, we certainly had pessimism, and we had buckets of it, loads of it. And this is very interesting, because pessimism is a wave 2 by its nature, and it follows a wave 1, and wave 1 is characterised by disbelief. Disbelief starts something after something is finished. It's starting something after something's finished. So, hey, it's a false dawn. Oh, it's too early. No, it's not right. It's all going to come back. False rally, and it comes down here. Told you so. Yeah, it's going back, and even the bulls start to feel horrible, and everyone gets really pessimistic, and that's a great buying time. But the really interesting thing about this period of disbelief is, when did the gold price bottom? March 1999. When did the oil price bottom? October 98. So we've had 10 years of bull market in gold and oil, 2 biggest commodities that are important, and no participation by the public or the institutions in oil stocks or gold stocks. The small cap gold stocks and oil stocks last year were down there, while BHP and the Woodside were up there with the oil price and or coal price and whatever. So the market breadth was very, very small. So I reckon we're there. We've done our first wave up. We've had a pullback, and the pullbacks we've had in the last week, everyone's gone, it's going down again. It's going down again. It's horrible, horrible. And Robert Prechter's out there. Yeah, here it goes. And we're doing another one. We're doing 2. And so we're about to start 3 of 3. Or another 1, 2 of 3. But anyway, it's there. That's where I think we are. And I take that in the view of what's happening in China and what's happening in South America and MENA and India, whatever I've spoken about previously. The Jim Rogers view is that, we've got 20 years of commodity bull market, all that sort of stuff. But basically, this is what the markets are telling me. This is what the markets are telling me, and not what some poor twisted misanthrope in Graceville or Alabama or wherever it is sort of telling us what's going to happen. So, our portfolio recommendations, obviously we want to be overweight the gold sector. We want to have the leaders. You've got to have liquidity, you need dividend income. You've got to have some mid-caps, you've got to have some new producers. And we usually have about 40% of our portfolio in the larger stocks, another 30% here, and then that leaves us to have 30% here and 20% in a whole range of things like this. Now, typically we'll have 3 or 4 of these stocks will make us 10, 20 times our money. 1 will be a dog, and 3 will be also rands. These things will perform with the market, these will outperform the market, and these guys will also give you very strong results. So when you take a portfolio approach, we can still make 100% or so on our portfolio, based on that. We've got to have at least 10 small caps and closer to 20, because we never know which one's going to run and which one's going to give us that 100 times our money. And we have had those things that have gone from sub $10 million market cap to $1 billion. And that's it. So, that's it. Yep, so thank you very much.